December 2022, this company is worth roughly $300 a share. It's the stock of the moment, the king of clean energy. Today, it trades around $30. Green energy is no longer in fashion, and so no one cares. I find this very interesting because when the market stops making distinctions, that's usually where the best opportunities are born. Today, we are talking about a company with 60% market share in American residential solar with the stock trading roughly 80% below its all-time highs. We are talking about Enphase Energy. I show you why Wall Street's indiscriminate selling may have created an asymmetric opportunity. But stay with me, there are serious risks too, and we are going to look at all of them. So, first of all, what does Enphase do? When you install solar panels on your roof, you need a device that converts the direct current from the panels into alternating current usable in your home. This is called an inverter. The traditional method is a string inverter, a single box that manages all the panels connected in series. This approach has one key problem. If one panel fails or ends up in shade, it drags down the entire system. Not only do you lose production that day, in the long run you are burning money and resources every time you wait for a technician. This bottleneck can be solved in two ways, with optimizers or with microinverters. Enphase was the first company to successfully commercialize the microinverter at scale. The microinverter is a small device installed beneath each individual panel. The advantage: if one panel is shaded or fails, all the others keep producing at 100%. But it's not just hardware. Enphase has built a complete ecosystem: microinverters, battery storage systems, EV chargers, and an app to monitor and control everything from your phone. At this point, you might be wondering, if optimizers exist too, why choose microinverter? There is no universal answer. A system with Enphase microinverters costs roughly 10 to 20% more than one with optimizers, but there is a concrete advantage. No single point of failure. With optimizers, there is always a central inverter. If it breaks down, the entire system stops. With microinverters, every panel is independent. So, over 25 years, the cost gap narrows to 5 to 12% because with Enphase, you never have to replace a central inverter, which typically lasts between 10 to 15 years. If you have a little extra money to put in your system, microinverters are generally the better choice. Why choose Enphase microinverters over the competition? First, a 25-year warranty, the highest on the market. Competitors offer 10 to 12 years as a standard, extending it costs extra. This is because Enphase products are built to superior quality standards. The declared failure rate is 0.05% per year, while competitors don't publish equivalent data. Second, guaranteed backward compatibility. You are buying from a solid company. If something breaks 10 years from now, spare parts exist and new products tend to be compatible with older systems. Now let's talk about the elephant in the room. The stock has crashed more than 87% from its December 2022 highs, when ENF was trading around $300. This is not an isolated case. SolarEdge met the same fate over the same period. Enphase's revenues depend primarily on how many microinverters and batteries they ship, and here we can see the data alongside Enphase's total revenues. Enphase is a highly cyclical business, and if you don't understand the cyclicality of the sector, you can't understand either why it crashed or why it could recover. The business depends on three variables. First, the interest rates. Solar installations are almost always financed. When rates rise, the monthly payment becomes unsustainable. People put it off, installers stop ordering, and Phase's revenue collapses. That's exactly what happened between 2022 and 2024. The Federal Reserve raised rates aggressively through 2022 and 2023, eventually peaking at 5.5%, the highest level in over 2 decades. The residential solar sector froze. Second, energy inflation. Families install solar panels when their electricity bill hurts. With geopolitical tensions in the Middle East and the conflict involving Iran and oil and gas prices still unstable, energy inflation isn't going away, and that's tailwind for Enphase. Third, fiscal incentives. For years, in many American and European states, there was the so-called net metering scheme, a simple mechanism. You produce energy, the excess goes back to the grid, and the utility credits you at decent rate. Result, batteries weren't needed. Then many states cut those incentives. California, the number one solar market in the US, drastically reduced net metering in 2023 with NEM 3.0. Now the energy you send back to the grid is worth a quarter of what it used to be. The direct consequence, fewer new systems are being built and batteries are becoming essential for systems already installed. If selling energy back to the grid isn't profitable, you store it, and to store it, you need a battery integrated into your microinverter ecosystem. In Europe, the story needs to be told honestly. Enphase has faced fierce competition, especially from Chinese manufacturers like Miles and Day, which sell microinverters and batteries at lower prices. The result, Enphase has had to cut prices to stay competitive, compressing European margins. In terms of international revenues, we are heading back to 2021 levels. But in Q1 2026, management has already flagged a revival in European demand driven by the inflationary wave in gas prices. Now, let me tell you the thing that surprised me most while researching this stock. During the Q1 earnings call, CEO Badri announced a new product. Not a new microinverter, not a new battery, a solid state transformer for AI data centers. It's called the IQ SST, IQ Solid State Transformer. Modern AI data centers are transitioning to 800-volt DC power architectures. The problem: traditional transformers are inefficient, massive, and can't handle the variability of AI workloads that shift in milliseconds. The IQ SST converts medium voltage AC directly into regulated 800-volt DC in a single conversion stage. Each 1.25 megawatt rack is made up of 342 hot swappable power modules, replaceable on the fly without shutting the system down. Efficiency 98.5% and availability of 99.999%. Sound familiar? It's exactly the same philosophy as the microinverter. Instead of a single centralized inverter that takes everything down with it if it fails, we have 342 distributed modules, native redundancy, zero single point of failure. Enphase has taken its core architecture and applied it to data center power delivery. The CEO estimates an addressable market in the US of 11 gigawatts by 2031. Each rack is worth 1.25 megawatts. 11 gigawatts equals more than 8,800 racks. We are talking about a market worth tens of billions completely separate from the residential solar. Here is the roadmap. Working samples already built. Full system demo end of 2026. Customer pilots 2027. Volume production 2028. This is not an earnings driver for the next few quarters, it's an option on the future, but markets love narratives, and Enphase enters AI data centers with proprietary technology is a narrative that can move the multiple long before the first dollar of revenue arrives. The difference before the usual AI stories, here there is a real technology, real patience, and a track record of execution. Let's talk about the main risks. First risk, fiscal incentives. With the signing of the One Big Beautiful Bill on July 4, 2025, the 30% federal tax credit for residential solar, Section 25D, was eliminated starting January 1st, 2026. Roughly 7 years ahead of the original IRA timeline, which had it running through 2032. This has already slowed American solar demand. Policies of this kind negatively impact every company tied to green energy. Second risk, interest rates. If rates were to stay elevated for an extended period or rise further, Enphase's business will take a significant hit and the stock along with it. Third risk, Chinese competition. Hoi Miles, Li, and other Chinese manufacturers are improving both quality and scale. In Europe, Enphase's margin is already under pressure. If this dynamic shifts to the US, it becomes a serious problem. Fourth risk, IQ SST execution. Getting from announcement to volume production requires years, capital, and customers willing to pilot the technology. The risk of delays or failed adoption is real. Let's move to the final part, valuation. Valuing a cyclical company is always complex. The risk is buying at peak earnings or selling at the trough, which is exactly the opposite of what makes sense. Running a reverse discounted cash flow on the current price, the market is implicitly pricing in free cash flow growth of around 10% annually over the coming years, assuming a 15% free cash flow margin. Looking at the drivers, the microinverter TAM is growing at an estimated 10% compound annual growth rate. Then, Trump continues to pressure the Federal Reserve for rate cuts. Energy inflation could prove stickier than expected, especially in Europe. AI requires an ever growing amount of energy. Electricity bills rise, solar demand rises. The IQ SST opens up an entirely new TAM. Even if two or three of these tailwinds materialize at the same time, the stock's re-rating can be really aggressive. This is not investment advice, always do your own research. To recap, Enphase is a company that has been through a brutal cycle, operating in a sector that is currently out of fashion and has just announced a product that could rewrite its growth profile for the next decade. Can it go wrong? Absolutely, but the risk reward at these prices deserves attention. If this kind of analysis interests you, subscribe to the channel, more are on the way. Leave a comment on which company you would like to deep dive on. Thanks for watching and see you next time.